For most of the 20th century, building wealth followed a strict, predictable script. You put your money into a standard bank account, contributed to a pension plan, and let the system handle the rest. That hands-off approach meant you were outsourcing every major financial decision to a massive network of institutional gatekeepers and fund managers. There was a hard physical boundary between the everyday saver and the actual chaos of the trading floor. You gave them your money, and they did the shouting. Financial security essentially required trusting a massive middleman to navigate the capital markets on your behalf. Between 2021 and 2024, a severe wave of inflation hit the global economy, aggressively eating into consumer disposable income. This line chart shows the mathematical reality. As global inflation rates spiked, the purchasing power of cash reserves steadily declined. Simultaneously, safety nets failed. Adding a third trend line shows the growing deficit between projected pension payouts and the rapidly rising cost of living. Holding cash guaranteed a loss. People could no longer rely on passive saving to survive. They needed higher returns. Squeezed by inflation and failing pensions, a massive pool of global capital started actively searching for a new home. Right as that macroeconomic pressure peaked, a boom in financial technology automated the physical processes that once required a trip to a bank branch or a phone call to a broker. Digital platforms replaced high account minimums and slow settlement times with instant, zero-commission execution. This shift allowed for the invention of fractional shares, meaning an individual could buy into major companies for the price of a coffee. This removal of specific hurdles changed the scale of participation. Today, 75% of all retail trades globally are executed directly on mobile devices. The smartphone did more than provide a connection. It decentralized the function of the institutional trading floor, moving the power of the exchange into the pockets of the public. More than 500 million everyday people worldwide are now actively invested in global capital markets. The geography of this capital is expanding rapidly across Asian emerging markets. By early 2024, the Shanghai Stock Exchange reported 200 million retail investor accounts. The H-base sign has plummeted. In the UK, 69% of Generation Z adults have now made investments, with a large portion opening accounts while still in university. And the gender gap is closing fast. Women accounted for 42% of new retail brokerage accounts in Europe recently, and a massive study of Australian portfolios showed female investors actively outperforming men. The profile of the global market mover has permanently shifted from a wealthy Wall Street professional to a highly diverse, young, and active civilian population. These new market participants aren't hiring expensive financial advisors. They are sourcing their financial education and investment research directly from social media platforms. This bar chart proves we are looking at a sustained behavioral evolution. While the media focused on brief, volatile spikes driven by viral meme stocks, the actual data reveals a massive, steady upward curve of overall global retail inflows stretching through 2025. Japanese retail investors recently purchased 819 billion yen in domestic equities and futures in a single week. Meanwhile, projections for the U.S. show another $425 billion in retail inflows expected by the end of the year. This sustained high-volume capital flow confirms that everyday people have permanently replaced passive saving with active market participation. Retail investors now wield trillions of dollars in collective capital. They act as a structural macroeconomic force, capable of driving and shaping broader market cycles. Legacy financial institutions are scrambling to catch up. They are frantically adapting their risk management models, redesigning their trading platforms, and pivoting their ESG priorities to appease this army of tech-savvy civilians. The institutional monopoly over global capital has been broken. Wall Street now has no choice but to share power with Main Street. The democratization of wealth generation provides direct access and opportunity previously restricted to the financial elite. But this direct access sidesteps the institutional layers that traditionally acted as a buffer. While the institutions remain, the safety net provided by professional oversight and fixed pensions is no longer the default for many. The hurdles have vanished, but the risk remains. The burden of securing a financial future has shifted directly into the hands of the individual.